Welcome everyone to In Conversation. We're now up to the third instalment of this Credabl webinar series, covering any number of topics to help medical professionals with their financial requirements. We've been inviting different members of the Credabl squad to share their expertise and insight into conversations that they've been having with medical clients around residential lending, commercial and practice finance, and of course some COVID-19 support. And today, the stellar lineup continues. For the first timers, my name is Ed, and once again I'll be your host today. I'm actually in the office this evening as my internet connection kindly failed me at home. It's quite empty here, but it's good to be back and hopefully signals the start of us all heading back to some form of normality soon enough. So this evening's 45-minute session takes on some new topics, and without sounding like a government advertisement, all of which you hear today is not advice and is general in nature. Also, to ensure this isn't just us talking to you, please use the live event Q&A section on the right-hand side of your screen to send us any questions you may have for the team. A quick reminder that if the live event Q&A panel is not open already, then you'll see a couple of speech bubbles with a little question mark to click. Android users, there will be a slight audio delay when you type into that Q&A section, but that audio will return. Okay, so hopefully you'll see my colleague Dina is there typing some comments, so feel free to follow her lead at any point and throw in any questions or comments that you like. All right then, enough of that and my chatting away, let's hear from the experts. First up will be Leanne Bolton. Leanne is the CFO of the Credabl business, and she's going to be imparting some wisdom around the questions you should be asking of your accountant. It is the end of financial year, and whilst it's been a little bit messy, there were a strong 3 quarters of trading in financial year 20. Then we move down to Melbourne and Craig Spiegel. Craig needs little introduction. He's seen it all and most likely met you all at some stage too. One of Craig's topics is around managing tax liability as we head towards the end of financial year. And that's the office cost savings on energy. And finally, we'll be chatting to Josh Mundy. Josh is going to give us thoughts on the response from the government and of equal importance, the business community. Once the team have wrapped up, I will be back to moderate the Q&A. So please keep those conversations coming in using the live event panel on the right-hand side. Okay then, let's get started. Leanne, the stage is all yours.
Thanks, Ed. Like many of my Credabl colleagues, I've been in medical finance industry for about 30 years, so it's like really showing my age now. But like most finance teams, we're usually in the background, just keeping our eyes on the business performance. So it's really fabulous for me having the opportunity to be client-facing today and be having a chat with you all. I think like it's recommended that we should have a 6-month dental or our annual medicals. It's really important to have a regular finance health check. I think end of financial year is the perfect time to do it. And the first thing you have to do is have an accountant who really understands the uniqueness of a medical or dental practice. There's some really great accounting firms or advisors out there who specialize in medical. It's really important that you have one who can benchmark you against other businesses that are similar to yours. So for example, if you're thinking about expanding, it would be good to get a good feel whether the dental practice down the road who has that extra chair is actually getting the returns that you're going to require, or if you've got a clinic, whether or not pathology would be the most cost-efficient use of your floor space. All of this information is really crucial when you're making your business decisions. However, I do caution that end of financial year is not the time to shop around for accountants. All accountants are extremely busy over this time, and a new one wouldn't have the time to dedicate to get to know you or your business in the level of detail that you'd need for them to be effective this financial year. So I suggest that's something you should consider early into the new year. The other thing is, don't wait until June to start getting your things in order. End of financial year actually starts now. You don't want to run out of time to take advantages of structures or strategies to minimize your tax or to maximize the tax efficiency of your business. The types of things that I would suggest that small business owners like yourself would do now, between now and 30th of June, is A, have a real good look at how your business performance is aligned with the business plan that you had. You still had 8 good months of trading pre-COVID to compare. So were your patient numbers where they needed to be? For those of you who do, kind of more expensive elective specialty medical dental procedures, like for example implants, where you're actually getting the conversion rates that you need. And this will give you a good feel as what your business as usual performance should be. And when the world normalizes, if it's going to normalize, or maybe I should say stabilizes, you might need to, consider whether you need to step up your marketing plan to attract new patients, or if your conversion rates are low to the more expensive procedures, maybe you need to introduce, payment finance options like zip money and the likes to help, get those conversion rates back up. And I guess for now, the world's not normal as we face the impacts of COVID-19, and all business owners and CFOs, myself included, we really focused on immediate cash flow needs. Cash is king, as they say, and we've heard it many times before, but in where we are now, cash really is king. So when your income's uncertain and your expenses are fixed, it's really important that you expect the best, but you plan for the worst. How does your business look if you receive none or limited income for 3 to 6 months? It's really likely that due to tax efficient structures that you have in place, that you have very limited surplus cash in your business account. So it's important to have a plan or to make sure that you can access surplus cash that may or may not be in your personal accounts, like mortgage offsets or the like, or to have access to some sort of working capital overdraft facilities. At least then you've got access to cash if you have a short-term cash shortfall. Have a look at the immediate cash saving strategies that you put in place to navigate COVID. It's really easy in business to let costs creep up without even seeing it happen, and bad, so-called bad costs creep in. And those are costs that you're not getting very much leverage from. And some are really small. It could be just, expensive paper in the photocopying machine, or you're printing in color when you don't really need to. Those can really add up if you're not careful. And so if you've made some immediate changes in response to COVID and you've cut costs back and your business is continuing without hindrance, then I would seriously be considering whether you can make those into permanent savings. I really encourage you to have a thorough look at your business performance to ensure that if you have had a downturn or if your business is not where you planned it to be, that it is actually COVID related and hence should be short term. I think you've got to remember that correlation is not always causation. That's why it's really important to have a good understanding of how your business was performing pre-COVID, during COVID, and your expectation post-COVID. And I guess as we're in the midst of COVID, it's also important that your accountant has applied for all the various government relief packages that have been put in place. So these include things like JobKeeper, the cash boost, there's deferrals or refunds of payroll tax, which is dependent on the state that you practice in. There's also deferrals, potential deferrals of GST payments, and code of conduct support on your commercial leases. So have a chat to your accountant, make sure they have in fact applied for all those for you, or where applicable. The next finance health check that you should be talking to your accountant about is whether your business is actually structured in the most efficient way to minimize tax and to make the most of all the deductions that you can. Now, paying tax is usually inevitable, so I would also be asking for a projection of what that tax liability might look like, so you can have a plan in place to have a look at what your cash flow would look like to make sure you can actually pay it, or whether you'd also need some sort of financing support. Very topical right now from a tax aspect is the $150,000 instant write-off, and that's in place until the 30th of June. This means that you'll be able to claim the full depreciation on assets that are acquired between the 12th of March and the 30th of June that cost, including GST, less than the $150,000. Now, per the tax ruling, these have to be in place and being used by the 30th of June. So if you're intending to make use of this, you have to be looking to purchase those assets now. Now, the increase in the threshold was put in place really at the start of the impact of COVID and was intended to stimulate the economy. I'm not sure if it was a response to early COVID warnings or if it was going to be put in place anyhow, but it was intended as a short-term stimulus and is to revert back to a maximum threshold of only being able to claim assets up to $1,000 from the 1st of July, which is incidentally is back where they were in 2014. if I was the commissioner, I would be extending this deadline, because I'm not sure that small business owners right now are making decisions around large capital purchases, but there's been no mention of a possible extension. So as I said, if you are planning to make use of this, then please do so sooner rather than later, to make sure that the assets have actually been delivered before the 1st of July. It's really important to do a regular check on your superannuation as well. Are you happy with your returns and the risk profile of your super fund? I think this year you've got to expect your returns to be down. The market has been all over the place. The volatility has just been, out of control. So you can't benchmark your super to how you performed last year. You'd need to be speaking to your accountant to benchmark your super performance against what else they've seen in the market, for a similar risk profile as yourselves. Many of you will have self-managed super funds that have been established already, so it's equally important to do a regular check-in at least once a year to make sure that you're invested in the right mix of assets in your fund. And I think, lastly, don't forget your insurances. Insurance for medicos are really complex, especially professional indemnity. So please ensure that you're using a broker who deals specifically with medical clients and medical insurance. We've seen many clients over the years that have either had insufficient insurance in place or are overpaying for their premiums for what they have. Your Credabl consultants and some of your accountants have been in the medical industry for many years, and they would be able to introduce you to specific medical insurance brokers. These brokers could review your policies and provide you appropriate advice. I think it's important to bear in mind, and I'm not saying it's widespread, but some accounting firms do have interest in insurance broking businesses, or they receive introducer fees from insurers. Now, it's not unscrupulous, it's market normal, but it doesn't always mean that the client is getting the best outcome for their specific needs, particularly when it comes to the intricacies of medical insurance. So please do your own homework too. And I guess, this year more than any other year, business owners like yourself will be better prepared for the end of financial year, because we've all had to respond really quickly to COVID. But most business owners will probably understandably be very short-term focused. So remember to still keep your eye on the medium term, as when your business comes through the other side of COVID, you want to be in the best possible position for growth. I think that just about covers the main things that I wanted to talk about. It's been really great chatting to you, but on that note, I'll pass back to Ed to introduce you to whoever's speaking next. Thank you.
Thank you, Leanne. Some seriously good takeaways there from our CFO. And already I can see some questions for the team, so please do keep them coming. Okay, let's get straight on to hearing from none other than Mr. Spiegel. Craig, it is over to you.
Thanks so much for that, Ed. Today I wanted to touch on three things. Current sentiment. Number two, things you can do now to manage your tax liability before the 30th of June. And number three, questions you and your colleagues are asking us right now. So firstly, it's great news that most restriction to practices have been eased. The easing has been different for different professional groups and across borders in some instances. The following is what we're hearing from our clients. I think everyone knows how dentistry had been hit with significant restrictions early on. Some practices closed completely, while others remained open for emergencies. Anecdotally, that saw income drop from obviously 100%, maybe down to 90 or 95%, so a significant change. I'm pleased to say that in my conversations this week and last week, as the stages or the restrictions have eased, that gross has come back to, on average, probably something like 60 or 70% of pre-COVID levels. And some practitioners are saying to me that as their books are filling out, they're seeing those levels coming back and hoping for June and July to be almost back to where things were before all of this coronavirus occurred. I think the practices that reviewed their expenses and implemented cost savings where possible, as Leanne mentioned, have a real opportunity going forward. These practices should come through in better shape than what they went in. This is especially true for practices where the principal was purely focused on the gross and the production. As we all know, profitability is about increasing the money that comes in and either stopping or reducing the money that goes out. So if principals can keep a really sharp focus and I should say their teams, keep a sharp focus on the expense line, the profitability will return before turnover reaches pre-COVID levels, and should see these practices more profitable once those gross gets back to the levels it was beforehand. A massive opportunity for all professionals. Elective surgery also is very different. That ceased in full, and as I understand it, the National Cabinet last week has reopened elective surgery, and I think the trajectory has gone from 25% of pre-COVID levels last week to something like 50% this week, which is great, and I'm sure that will change or alter marginally from state to state. Obviously, it's going to need the hospitals to actually bring back the capacity. There was an interesting article also last week which stated that if the turnover can increase by approximately 10% on top of normal COVID levels, or sorry, pre-COVID activity, it's going to take almost a year to catch up for the delay that we've just had in the last 6 to 8 weeks. Some of our clients used their theatre time to pivot and engaged fairly heavily in a lot of online type consulting. This allowed them to stay connected to the patients, replace some of their lost surgical fees, and more importantly, has laid the ground for surgery when capacity returns. Overall, what I'm saying is that practices are feeling more optimistic, the income generating is increasing, and patients are returning. Now to the boring bit, pre-30 June tax considerations. The first thing I think you need to do in concert with your accountant is to work out if you want to bring the deductions forward into this year or actually have a preference to push them to next year. The reality is most professionals would have had, in my opinion, a good 10 out of 12 months worth of trading in this year. And any deductions you don't take now will see you pay around half of that to the tax man or woman 12 months from now. If you've applied for JobKeeper and the other government entitlements, you should have a very clear picture of your financial situation. The types of strategies that we're in conversation right now with our clients is, number one, if you have any sort of investment loans, be it commercial or residential property, you have an opportunity to prepay your interest in this tax year and forward the deductions. Number two, if you have a finance lease, which is typically for equipment or fit out, you could make additional repayments before the end of June. And that can be somewhere between 1 and 12 additional repayments. Of course, speak to your accountant or bookkeeper to see what's best for you. Number three, and Leanne touched on superannuation, you should look to maximise your super contributions. Most of our clients tend to leave their contributions to the end of the financial year, right about now. And so I would encourage you to ensure that you maximise that where possible. We all know the market is down compared to 6 months ago, so now might be a great time to acquire some additional equities or other assets as appropriate to you. And also, while we're at it, if you've happened to made a capital gain in the first half of this year, right now reviewing your portfolio is critical in order to potentially offset any of those gains with losses for assets that you don't feel are very good long-term holds for you. I guess rent and loan repayments are another thing for consideration. Should you make them this year and potentially defer them from July, or the other way around? This, of course, will depend on your current income and your sentiment as to next year's performance. Most of these payments are fully deductible. Number five, prepay other expenses. And these are things like insurance premiums, such as building, contents, or income protection. You might look to make some additional consumable purchases for your practice because those purchases are 100% deductible. And of course, there's a question of a capital acquisition. And capital equipment, for the most part, is fully deductible. And my colleague Josh will go through that in more detail. And I think lastly, around a tax year, we often see a lot more activity around the buying and selling of practices, obviously to either take the capital gain in next year or this year. So if you're considering it or in the process of buying or selling, you really need to look at making sure you maximise the timing of those actions. And lastly, what's hot? So the sort of questions we've got are, what does the current lending landscape look like? And the reality is several of the banks have changed their policies in relation to coronavirus, which has essentially made things tougher for you to borrow for things that you might have done 3 months ago. Other lenders have withdrawn approvals outright. It's fair to say that, generally speaking, some of the banks or lenders are actually seeking additional securities today than they would have previously, which means looking at taking security over properties and or companies that you have that aren't necessarily part of the transaction that you're looking to undertake. For Credabl, it's business as usual, no changes. Another question is, what are my options if I've already deferred my repayments? Well, I guess firstly, your lender should have discussed with you what your options are and the implications of each of your options up front. In simple terms, the longer you borrow money for, the more it costs. Right now, you could ask your lender to stop the deferral outright or potentially start making part repayments. And I guess all of that's premised on the fact that there is general income coming into your clinic that's at a level that gives you confidence to actually start covering your costs. And lastly, a lot of people are saying, well, looking forward, what can I do to shore up my financial position? I guess it used to be called having money available for a rainy day. And the simplest way to do that is to look at lines of credit where you've got a facility there for you to draw down on as you need it. There are options to do that unsecured or secured. And the other thing that a lot of clients are talking to us about is reviewing their existing facilities to see, are they up to scratch in the market such that they have an opportunity to reduce their cash flow commitment. Again, a long-term benefit. Well, I guess that's it for me. I hope that gives you all some idea on how to end and start your new financial year. I'll pass back to Ed now to introduce you to our next speaker. Thank you.
Thank you, Craig. I have no doubt there'll be plenty of questions for you as we all inch closer to the post-COVID world. Please remember to keep those questions coming in and feel free to put your name in there too. But now we're actually going back to back and on to another of the Credabl founders who is also somewhere here in the office. Good evening, Josh.
Good evening, Ed. Great to be joining you all. Great to be back here actually in the HQ of Credabl here in Sydney. It's quite a surreal feeling having not been here for 2 months now. So look, tonight what I wanted to do was share my thoughts on the key takeouts we've seen from some of those government measures, but also share some insights that we've been seeing in terms of what the business community, how they've been impacted, what response that they're taking. So starting with the government, really there's 2 key measures here that apply to medical professionals outside of the JobKeeper or Job Seeker. And really that's related to any asset purchases you might be considering this financial year. The first one, it's great news for anybody looking at purchasing. We've seen an increase in the instant asset write-off last year from $30,000 fivefold up to $150,000. So as touched on by Lee and Craig, certainly a large tax deduction that wasn't available previously. And it's also worth mentioning on that the government's decided not to restrict it on a per item basis, meaning those that are in larger clinics or perhaps have multiple clinics would be able to purchase multiple items at that price level. So certainly something to be looking at from a purchasing point of view and to be discussing with your accountant. The second one is really mostly relevant for anybody who's looking at higher end diagnostic equipment, some scanners or lasers, and that's looking at anything that's above the $150,000 price point. That's working much the same way as the initial one I described, with the caveat being you can only deduct half of it up front. So whatever that amount is, you're able to deduct half of that from your taxable income this year, with the remaining balance being depreciated through a normal schedule, which your accountant would certainly be across. So, I mean, the key message here is that it's providing cash flow benefits for businesses that without it may not have made those purchases. And so it's certainly something that the business community in health has welcomed, and we commend the government for those efforts. But it's not all about the government, and there's only so much intervention you probably want from the government, and the rest is going to come down to us in the business community. So I thought what might be interesting would be to share with you what we've been seeing. Looking in the revision mirror, what has been some of the impact to community over the last 2 months, and then looking forward, what are we seeing around purchasing? So firstly, the most obvious one that's had a huge impact is on client and community engagement. It was actually this day, almost 2 months ago, that the government announced restrictions. Our team was at ADX, a large dental exhibition, which was called off at that time. So what we've seen is the complete halt of any type of client engagement, and that's as simple as clinic visits. Your sales reps, your product and support staff from your suppliers can no longer come in and see you. And on any given day, as we all know, there's tens, if not hundreds, of events happening in the medical community, everything ranging from large global exhibitions with associations down to regional surgical training, local webinars, seminars, study clubs. There's a lot. All of these were channels and opportunities for service providers to exchange information with medicos, and that has proven quite difficult to do in these circumstances. It's been interesting to see how people are responding. It's been the rise of technology. A great example is right now. I mean, I would be usually talking to you on a stand at a show in person, seeing your reactions, and now I find myself staring into a computer screen at night. So certainly a new normal for all of us to adjust. It'll be interesting to see what happens. We don't know. Nobody knows how quickly we will resume to normality or what type of activity will be allowed to happen. So that's had a big impact, certainly on the business community. The second has been around supply chains and securing products and services. A great example is what we've all experienced as consumers and humans trying to source products over this time. For us, it was toilet paper for home and pasta for the kids. But in businesses, that's been crucial medical supplies, protective equipment in order to adhere to any regulation around COVID. Obviously, there's been unprecedented demand globally for those products. That caused a real issue, both in terms of inflation of prices and the availability of stock. A great example in Australia we saw here was in the animal health industry, with the largest distributor here securing a significant shipment of PPE gear from Brazil before their cases started to rise. And it's interesting to note the pricing pressures we're seeing. To give people an idea, the price for that gear in December versus the price in March was tenfold. So all we're seeing here is inflationary pressures on pricing, increased orders on critical supplies, and that's starting to flow right through all of the different modalities. So certainly something to be aware of as you plan for your orders in the year ahead. And lastly, probably most significantly, has been the impact of purchasing activity and confidence, no matter what industry you're in. There's been nowhere to hide, but in the health space, that's had a huge impact right across diagnostic equipment, looking at things like implants, surgical consumables, and even through to some of those softer business expenses, things like motivational courses, marketing spend. It essentially fell off a cliff in March and had quite a tough time in April. So that's been a real challenge that we've been busy working with stakeholders right across the community. I'm pleased to say that we've been able to put in place some funding options that weren't available, broadly speaking. And I think Lee mentioned Zip Pay. I think the best way I can explain it is essentially this is a buy now, pay later type of offering on steroids for large medical purchases that you're able to purchase now and defer any repayment for a 12-month period. So critically important is, well, who's paying for that? What is the cost? And I'm actually really proud to say that the business community has come together and contributed to cover that interest for that period. And what they've done is taken spend from events and marketing and redirected that resource to solve the real challenge we're all facing right now, which is reduced income. So if you're thinking about purchasing, certainly coming back to Lee and to Craig, you want to be clear on your plans and potential scenarios that might happen. If you do find yourself in a decision a time that it's a decision to buy. We haven't seen conditions like this before, both from the government stimulus and the ability not to pay at no cost for 12 months is significant. So certainly encouraging people to be in touch with their consultants of those providers and seeing what options they have available, as it's a great time to be looking at those things. And lastly, I thought I'd just bring that to real life and try and give you an example of what that could look like. So I know we have a lot of dentists on the line, and it'd be part of our client base. If you were a dentist practicing this year and had potentially $200,000 of taxable profit, you're probably due to pay the tax man about 90 grand shortly if you took 45 cents in the dollar, if you were to do nothing in terms of purchasing. So that's money out the door that you can't change unless you're looking to make some purchases in the business. If we took an example of a $100,000 CBCT, a lot of movement into digital dentistry, the true cost of that machine to you after you deducted the $100,000 off your income is probably closer to $55,000. And you could pay cash for that now, but if you then factored in any of these buy now, pay later facilities available, it's starting to become really attractive. You're looking at a 12-month period to bring in that technology, get your staff familiar with the treatments, start to bring in income, and come June, July next year, you'd start to repay that. And I commend the industry in contributing to the cost of that for business owners. So I guess the message from me is there's a lot happening right across the space. Make sure you're in touch with your reps. If they're good, I'm sure they're reaching out to you anyway. We're certainly here to help. And if there's anything we can do, please reach out. So back to you, Ed.
Thank you, Josh. Good to hear from you as ever, mate. So now it's time to put the questions that you've been sending in to the team. Please do keep sharing any questions, and I'll get to as many as I can over the next 10-15 minutes or so. We've had a couple come in, so I think the first one we're going to go with is actually to Craig Spiegel. Craig, what is the market like currently with commercial premises? Has COVID-19 caused a fall in prices?
Ed, I guess in my opinion, that's a two-pronged answer. I think the first one is how's property going for owner-occupied medical space, and then there's general retail. Firstly, with all the properties that we're currently funding and getting valued, there's been no decline in prices at all. Some people see those assets as defensive and therefore actually might attract a premium. I think though, it's too early to tell about the other space, so retail. My gut feeling, and it's only my gut feeling, is that as landlord incentives fall away and loans return, and maybe some businesses don't reopen, you're probably going to find a glut of properties and therefore a likely decline in their values, and so possibly great buying opportunity for your investment, or if you're currently renting, to organise and acquire your own practice premises.
Thank you, Craig. Don't go anywhere because I've got quite a few for you, but next one is actually for Leanne. Leanne, I'm going to ask you this one. For the goods to be included in the 150k asset write-off, did they have to be purchased between the 12th of March and June the 30th, or just installed during that time?
Thanks, Ed. Yes, they just have to be installed by that time. So look, I think there'd be a reasonability test. I mean, for example, if they were purchased a year ago, delivered and sitting in a shed somewhere and not being used, they probably would be not allowed. But the deduction works on when it's installed and delivered and what the write-off is at that time. So it just has to be delivered.
Thank you very much. And I've actually think I've got a bit of an extension to that one through a new question, which is, what if I buy some equipment, but through factors out of my control, it doesn't get installed before 30th of June? Can I still claim the item if it's below the $150,000 threshold?
The short answer is no. The tax ruling is really clear on it has to be installed and delivered. So there is, no avenue to ask for an extension on that, unless the commissioner himself extends that deadline, as I mentioned earlier, to try to stimulate the economy a bit more, but unfortunately not.
Thank you very much. So we've got quite a technical one here, which Craig, no surprise, I'm going to throw to you. This is from Rob. if I were to buy a dental practice, for example, $400,000 before the 30th of June, could I break the total cost down into separate items, all of which would be under $150,000 in value, in order to write off the full $400,000 this financial year?
Hi, Rob. Good evening. Good question. I guess, again, there's two aspects to it. Firstly, from a funding point of view, there'd be no issues if that's how the sale documents were reflected. Ultimately, it's going to be a question of the buyer and the seller coming to an agreement and an understanding, and their accountants and advisors also being comfortable with that sale. Obviously, every practice is different, the assets in the clinic, the turnover. So I think realistically, the answer would be yes, there'd be a way to do it, but it's very much up to buyer and seller to agree a contract of sale that reflects that. Funding, that would be more than okay.
Thank you very much. Josh, I've got one for you. What is the catch for the no repayments for a year that I've been seeing in market?
Good question, Ed. The catch comes down to whether or not the interest is accumulating over that deferral period of 12 months. The example I gave of a CBCT, if it wasn't accumulating come July next year, you would still have a loan balance of $100,000, and you would then opt to repay that over a defined period. So it just comes down to whether or not the supplier has contributed and covered the interest, or the interest is actually accumulating. So I would suggest people take that up with their sales rep.
Thank you, Josh. So I've got some good questions coming in here, keeping me on my toes. Next one is for Leanne, I would suggest. Does the instant asset write-off apply to motor vehicles?
Sure, yes it does, but it's not as straightforward as other business assets. There's some qualifications around it. So first of all, obviously they have to be under the threshold, but even if it's under the threshold, you can only claim the amount that's deemed by the ATO to be the maximum value of business use. Off the top of my head, I'm not sure, I think it's around 57,000, 58,000, somewhere around there. And if you claim that, you can't double dip that by claiming cents per kilometre too. So this is one I'd suggest that you do have a good chat to your accountant about.
Thank you. Seems to be a common theme. Chat to the accountant. Craig, another one for you down in Melbourne. What deferral options are best? Which is the lowest cost option?
Chat to your accountant? No, just kidding. Look, I guess I commented on it earlier with respect to other scenarios. The longer you borrow money for, the more it costs. So the reality is the more you can pay, which is the less you can defer, the better off you are, subject to your ability to afford those commitments. So my suggestion now is if you can afford your payments that you've deferred, cease the deferral and get your bank to reinstate normal payments. If you've deferred and you don't want to reinstate the payments, make sure you know what happens to those deferred repayments. Many lenders have pushed them to the very end of the contract, which would be the most expensive option. At minimum, you'd want to spread it over the life of the contract if you can, in terms of cash flow. Otherwise, a line of credit might be the best way to manage some of these short-term cash flow issues, because that allows you to repay it much quicker and therefore save you money. I think that answers it, Ed.
Very good. Thank you, Craig. Leanne, I've got a slightly tricky one for you here, I'm afraid. What are the right assets to have in your self-managed super fund?
Sure, I'm happy to answer that one, but I'm going to do the typical accountant thing again and just remind everyone that everything in this webinar is general information and not advice, and you do really need to speak to your accountant and your financial advisor. I guess though, when it comes to your super, there is no one size fits all. The mix of your assets in your super fund is dependent on many factors: your age, the stage of your career. For example, if you've got an established practice, you may want to consider owner-occupied commercial property, but you need to consider how much cash you've got available. Do you want income returns, or do you want capital appreciation? So it's really quite complex, and it depends what type of risk or risk averse you are. So again, you do need to speak to your accountant. I'm sorry, Ed, that I couldn't be more specific on that one.
Very good. Thank you very much. I actually got one more here, and it looks like it's from a colleague of mine. Don't think I can't see who you are. I'm going to send it to Craig. If I buy an item before the 30th of June and it's under $150,000 and finance the item, can I claim the finance costs on top of the item itself?
Okay, I guess it. So the answer is absolutely. You can claim the 150, as it's already been mentioned by my colleagues. In terms of the costs, if there's any cost to set up the funding, yes, you can cover that in this tax year. And then, of course, the interest is deductible as well, but that's generally going to be paid over time. So any interest that you bring into this tax year can be deducted. Otherwise, the balance of those finance costs can be deducted, but it will be in subsequent years. And I think that really covers it. Otherwise, Nick is more than welcome to give me a call and I'll run through it.
Very good, thank you, Craig. And you know what? That's actually time at the bar here. So I'm probably going to wrap up the questions. Thank you all for those questions and also for your time. Look, we really enjoy hearing what you have to say, and it's great to put our squad on the spot with those questions. As always, if there are any more topics that you would like us to cover, please leave a message in that live Q&A now, or contact us directly via the website. Our live chat on the website is always on, and there's always someone awake. Or maybe you could advise us on what time suits you best for a live webinar like this. I mean, the lights went off here, but whatever time suits you. We're a pretty versatile bunch and happy to be live for whenever suits you best. Thank you to Leanne, to Craig and to Josh for their insights today. And we hope you enjoyed this conversation and will join us for the next one. The events team will have an invite out to your emails shortly. Have a great rest of the week and see you all soon.